Does it feel like your money and retirement is in danger? With prices still elevated, high interest rates, and the mounting national debt, the present and future purchasing power and cost of living of everyday Americans is more and more uncertain. All the while, central banks around the world are reducing their dollar reserves and buying gold in record amounts not seen in history. Are central banks sensing weakness in the dollar and counterparty risk by holding it in reserve? If the smart money that usually run the printing presses are stocking up on gold, it makes sense that the ordinary investor prepare as well. And how can investments in scarce assets like physical gold and digital decentralized technologies like Bitcoin be used to counterbalance this constant erosion of our purchasing power? If you think that you may be falling short of your retirement goals, see the link in the video description to the free inflation and retirement calculator to discuss why gold works, why fiat currencies ultimately fail, and why gold and other scarce assets act as an insurance policy against risk. We will hear from economist, White House advisor, and author Jim Rickards, macro analyst and investor Lyn Alden, macroeconomist Luke Grommen, and economist and investor Keith Weiner.
And Secretary Connolly said, well, it's our dollar, but it's your problem. So institutions are looking at things probably arguably in a more sophisticated way. But all the major currencies of the world are dollar derivatives. That is, the central banks hold dollars as their reserve asset, or they hold euros, and the European Central Bank holds dollars anyway. So they're dollar derivatives. And so they couldn't possibly survive if the dollar were to collapse first. They couldn't survive the collapse of it, because if you're derived from something and the thing from which you're derived is collapsing, you're going to go down too. It'd be like if you had call options on Google and then Google were to collapse. There's no way the call option would still have value after that. Gold is the one financial asset that has no counterparty risk. So if you think there's going to be some sort of crisis or problem, and you think, okay, I want to decrease my exposure to that, gold is the asset that you turn to. It could be that the central banks are aware of rising stresses in the system and seek to hedge against whatever risks they perceive.
The Federal Reserve and other Western central banks kind of find themselves in a tough position right now, because on one hand, they've never been further behind the curve in terms of inflation, at least going back to about 1951. So in modern history, they're about the furthest they've ever been behind. And look back, in history during prior inflationary episodes in the market, and we see that there are very different types of responses depending on how much debt is in the system. And so when we think of high inflation, we often think of the 1970s. I use 3-month treasury bills as a proxy for short-term rates here, because the data set goes back really far. But essentially what you had here was the Federal Reserve was constantly trying to tighten and raise rates to rein in inflation. And they were able to do that in large part because debt as a percentage of GDP, both in the public debt and private debt, including household debt, corporate debt, all the different types of debt outstanding, they were pretty low. And so they were able to raise rates, and it caused economic weakness, didn't necessarily cause like a solvency event. Whereas back in the 1940s was the last time debt as a percentage of GDP was as high as it is now. You had a pretty big decoupling in terms of inflation and interest rate policy. And so I think a lot of macro indicators show that the 2020s are shaping up to be very similar. I mean, we already had this big spike here. We had, the largest ever decoupling in terms of inflation and rates since the 1950s. And I think we're going to get probably more cycles of that going forward.
You already had the U.S. and EU sovereign debt credibility under threat as a reserve asset. And given the U.S. fiscal situation, the European fiscal debt situation, the U.S. debt situation, the reaction to the Ukraine crisis in particular, the U.S. and EU sanctions of Russia's FX reserves, I think are a Pandora's box that has been opened and I don't think can be reclosed. And so I've talked about it potentially being on level with the U.S.'s closing of the gold window in 1971 from a monetary perspective. We've seen shifts by the Russians, by the Chinese, out of dollars into gold in the case of the Russians, out of dollars into gold. I think it goes into things that better hold purchasing power, right? So it's going to be gold, hard assets.
All this, by the way, is very detrimental to the dollar's role as the leading reserve and payments currencies. And I've said this to people in Washington. I do a bit of consulting and meetings with people in the national security space, including government officials, intelligence community, Defense Department, et cetera, Treasury. And I've said to them, I said, look, using our weight, using the dollar as a weapon is extremely powerful, but be careful what you wish for, because the more you throw your weight around, the more people aren't just going to stand for it, the more they're going to build alternative systems. And someday you're going to wake up and find that, you're pushing on a string, you're trying to punish people with dollar-specific sanctions, and they don't work anymore because no one needs the dollar. We're not there yet, but we're pretty far down that road. They're doing it several ways. One is reducing their exposure to dollar holdings, not all at once, not dumping them en masse. But if you look at, there's something called the Tick Report, which comes out from the Treasury periodically. I think it's once a month, or it's at least quarterly, and it shows foreign holdings of U.S. Treasury securities. And if you look at the official holdings, they are going down significantly, and they have for a while. So it is true that China and Russia in particular, but other countries as well, are reducing their holdings of U.S. Treasury securities. But what they are doing is buying gold. So if gold is not a monetary asset, if gold is a barbarous relic, as the critics like to say, why have Russia and China tripled their gold reserves in the last, as I say, between 5 and 10 years approximately, and continue to buy more gold every month? Russia's buying 20, 30 tons a month, sometimes more, sometimes less, but that's kind of been the run rate. Are they stupid, or do they see something that most people don't? Well, I guarantee they're not stupid. I've been to Moscow and Beijing, Shanghai, and met with officials there, and they're very, very savvy. So clearly they see something that most investors don't see, and they're getting ready for this, collapse of confidence in the dollar. It doesn't mean we won't have dollars. It doesn't mean the dollar goes away. But what it does mean is that the dollar very quickly and unexpectedly almost loses its status as the benchmark global reserve currency, to be replaced probably by the IMF special drawing right, but if not, some new gold-backed currency.
I've been using the 1940s to characterize this era more so than the 70s, which is kind of the popular conception right now. They had fewer assets available to them because gold was illegal to own for Americans. Many, foreign pools of capital went into places like gold where they could. Commodities did well, broad commodities, silver, oil. Equities were very volatile in that period because you obviously had a lot of uncertainty, and equities are long duration assets, and so it's hard to price them appropriately when you don't know the economic outlook. And luckily now, even though we're in some ways going through a similar macroeconomic cycle as the 40s, investors have more tools available to protect their capital against these periods of currency devaluation that you can go through when you have that combination of high debt with some degree of inflation.
If you are concerned about your long-term wealth preservation, then the fiat dollar is clearly failing you. Gold is clearly on the rise and making historic highs. The 5,000-year history, gold is the one asset that has outlasted numerous business cycles, economic downturns, booms and busts, stock market bubbles, and the rise and fall of every currency. And unlike depreciating faith-based fiat currency, gold is no one's liability. Gold IRAs provide a tax-deferred means of building wealth, storing it securely, as well as protecting your retirement and purchasing power from counterparty risk. If you are ready to start your gold investing journey, see the links in the video description to the best gold IRA companies that we have personally reviewed and vetted. To attend a free gold education webinar held by Augusta Precious Metals, see the link in the video description. Thanks for watching.